March 14th, 2023. James Chen unlocks the door to his restaurant for the last time. 23 years he's owned this place. Started as a food truck in 2000, saved every dollar, bought the building in 2010, employed 14 people, fed 3 generations of families in this neighborhood. But today he's putting a sign in the window, permanently closed. His crime? He borrowed money, a reasonable amount. $300,000 to expand the kitchen in Taiwan. The loan made sense at the time. Interest rate was 3%. Monthly payment was $1,200. Manageable from revenue, but then the Federal Reserve started raising rates. March 2022, first increase, a quarter point, no big deal. May, another half point. June, 3/4, July, 3/4 again. By February 2023, the Fed had raised rates by 4.5 percentage points, the fastest increase in 40 years. James's loan had a variable rate tied to the prime rate. As the Fed raised rates, his monthly payment climbed. $1,200 became $1,800, then $2,400, then $3,000. His revenue didn't change. His costs didn't change. Just the debt service. By March 2023, debt payments consumed all his profit plus some. He couldn't make payroll and the loan payment, so he closed. 14 people lost jobs. The bank foreclosed on the building. James lost his life savings, $300,000 in equity gone. 2 months later, James Chen was found dead in his apartment. The coroner ruled it suicide. Antidepressants and alcohol. No note. His family said he'd been despondent since the closure. Couldn't sleep, couldn't eat, felt like a failure. He was 58 years old, should have been thinking about retirement. Instead, he's another statistic. Another casualty of central bank policy, another body in the count that nobody's counting. This is not an isolated story. This is a pattern, a mechanism, a predictable consequence of interest rate policy that central bankers understand perfectly but execute anyway. Because in their calculus, some people have to die. Not directly, not visibly, but through the mechanisms that interest rates trigger: business failures, job losses, poverty, despair, and eventually death. The Federal Reserve doesn't pull the trigger, but they load the gun, aim it at specific demographics, and pull the monetary policy lever knowing exactly what happens next. This is the story of how interest rates kill, not metaphorically. Literally, with a body count that would qualify as mass casualty if it happened in a single event. But because it happens slowly, diffusely, across years and millions of people, nobody calls it what it is. Murder by policy, democide through interest rates, the hidden body count of central bank decisions. Let me show you how the weapon works. Interest rates are the price of money. When the Federal Reserve raises rates, borrowing becomes more expensive, mortgages cost more, business loans cost more, credit cards cost more, car loans cost more. Every form of debt becomes more expensive to service. This is the intended effect. The Fed raises rates to slow the economy, to reduce demand, to fight inflation. The theory is that when borrowing costs more, people borrow less, spend less, demand decreases, and prices stabilize. But here's what the theory doesn't account for: existing debt. When the Fed raises rates, they're not just making new borrowing expensive, they're making existing variable rate debt more expensive. Adjustable rate mortgages reset at higher rates. Business credit lines reprice higher. Home equity lines jump. Student loans with variable rates increase. Millions of borrowers who took debt at 3% suddenly owe at 7%. Their income didn't increase, their revenue didn't change, but their debt service doubled or tripled. This is the first kill mechanism. Debt service shock. You're a small business owner like James Chen. You borrowed at rates that made sense. Your business was profitable. Then rates increase 4.5 percentage points in 12 months. Your debt payments explode. You can't refinance because your collateral declined in value when rates rose. You can't raise prices because your customers are facing the same pressure. You can't cut costs because you're already lean. So you close. And 14 people lose their jobs and your life savings disappear. And the stress of that failure kills you. The Fed didn't intend to kill James Chen specifically, but they intended to cause business failures. And business failures cause deaths. The mechanism is clear. The outcome is predictable, and they do it anyway. The second kill mechanism is unemployment. When businesses close or cut back because debt service increased, people lose jobs. The Fed actually wants this. They say it explicitly. Jerome Powell, Federal Reserve Chairman, said in a 2022 press conference that the labor market needs to soften. That's central banker language for people need to lose their jobs. Because when people lose jobs, wages stop rising. When wages stop rising, inflation decreases. The Fed targets unemployment. They aim for job losses. They engineer recessions specifically to make people unemployed. And unemployment kills. Not immediately, not obviously, but consistently. Research shows that unemployment increases mortality through multiple pathways. Suicide rates increase. A person who loses their job is 2 to 3 times more likely to die by suicide than an employed person. Cardiovascular disease increases. The stress of unemployment causes heart attacks and strokes. Substance abuse increases. Unemployed people are more likely to abuse alcohol and drugs, leading to overdose deaths. Healthcare access decreases. Losing a job often means losing health insurance, meaning treatable conditions become fatal. And these effects compound. The longer someone is unemployed, the higher their mortality risk. Studies from multiple countries across multiple decades show the same pattern. A 1 percentage point increase in unemployment causes thousands of additional deaths. The exact number varies by study and country, but the relationship is consistent. More unemployment equals more deaths, and the Federal Reserve causes unemployment deliberately. As policy, they raise rates knowing it will cause job losses, knowing those job losses will cause deaths, and they do it anyway. Because in their calculus, those deaths are acceptable, necessary even. The cost of fighting inflation. Let me give you the numbers. The Federal Reserve's interest rate increases from March 2022 to July 2023 raised the federal funds rate from 0.25% to 5.5%. This is projected to increase the unemployment rate by approximately 1.5 percentage points above the baseline. The labor force is 165 million people. A 1.5 percentage point increase means approximately 2.5 million additional unemployed people. Studies suggest that unemployment increases mortality by about 50 deaths per 100,000 unemployed per year. That's on 250 additional deaths per year from the unemployment caused by these rate increases. Over a 5-year period, that's 6,250 deaths directly attributable to Federal Reserve policy. But that's just unemployment. That doesn't count business owner suicides like James Chen, doesn't count deaths from deferred medical care due to economic stress, doesn't count domestic violence deaths that increase during economic hardship, doesn't count deaths from housing instability and homelessness caused by induced affordability crises. The full body count is much higher, and nobody's calculating it, nobody's publishing it, nobody's holding the Fed accountable for it. The third kill mechanism is Housing. When interest rates rise, mortgage rates rise. In January 2021, the average 30-year mortgage rate was 2.65%. By October 2023, it reached 7.79%. That's a tripling of mortgage rates in less than 3 years. This has multiple deadly effects. First, it makes housing unaffordable for buyers. A $400,000 home at 2.65% requires a monthly payment of $1,609. The same home at 7.79% requires $2,154. That's a 77% increase in monthly payment for the same house. Millions of people who could afford to buy at low rates are locked out at high rates. They remain renters, and renters have less stability, less wealth accumulation, and higher mortality than homeowners. Housing insecurity kills. Second, it causes foreclosures. People with adjustable rate mortgages see their payments increase. Some can't afford the higher payments. They default, the bank forecloses, they lose their home, and homelessness has a mortality rate 3 to 4 times higher than housed populations. Every foreclosure carries a death risk. The Fed's rate increases cause foreclosures. Those foreclosures cause homelessness, and homelessness causes death. Third, it crashes home values. When mortgage rates rise, home prices fall. People who bought at the peak now have homes worth less than their mortgage. They're underwater, can't sell without taking a massive loss, can't refinance because they have no equity. They're trapped, and that financial stress causes health problems: cardiovascular disease, mental health crises, substance abuse, and eventually death. Let's look at historical precedents, because this isn't the first time the Federal Reserve has killed people through interest rate policy. It's a pattern, a repeated mechanism, and the body count from previous cycles tells us what to expect from the current one. 1980 to 1982. Federal Reserve Chairman Paul Volcker raises interest rates to fight inflation. The inflation rate in 1980 was 13.5%. Volcker decided it had to be broken. He raised the federal funds rate to 20%. 20%, the highest in American history. The economic effects were immediate and devastating. Unemployment rose from 6% to 10.8%. 4 million additional unemployed. Manufacturing collapsed. The Rust Belt was hollowed out. Farms foreclosed across the Midwest. Suicide rates among farmers hit record levels. Small businesses failed en masse. The human cost was catastrophic. Suicide rates increased 15% during the 1982 period. That's approximately 6,000 additional suicides per year. Over 3 years, 18,000 deaths. Domestic violence deaths increased. Substance abuse deaths increased. And these are just the direct measurable deaths. The indirect deaths from stress-related illness, deferred medical care, and poverty-related health decline likely added tens of thousands more. But the policy worked. Inflation fell from 13.5% in 1980 to 3.2% in 1983. The Fed declared victory, the economy recovered, and the 18,000 dead were forgotten, not memorialized, not compensated, not even acknowledged, just acceptable casualties of monetary policy. Paul Volcker is celebrated as the Fed chairman who saved the dollar. His legacy is fighting inflation. The body count isn't mentioned. 2008 to 2015. The opposite problem. The Fed lowered rates to zero to fight the financial crisis. This saved the banks, prevented systemic collapse. But it had its own body count. Zero interest rates destroyed savers. Retirees living on fixed income saw their investment returns evaporate. A $1 million nest egg that previously generated $50,000 per year in safe returns now generated $10,000. Retirees couldn't afford to live. Some returned to work in their 70s. Some moved in with children. Some cut medications to afford food. And some died earlier than they would have with adequate income. Studies show that financial stress in retirement increases mortality. Retirees under financial pressure die 2 to 3 years earlier on average than financially secure retirees. The Fed's zero interest rate policy put millions of retirees under financial pressure. How many years of life were lost? How many deaths occurred earlier than they would have otherwise? Nobody calculated it. But the mechanism is clear. Low rates punish savers. Financial stress kills. Therefore, low rates kill savers. The zero rate policy also created asset bubbles. Stocks inflated, real estate inflated. People felt wealthy, took on more debt, spent more. Then, when rates eventually rose, the bubbles popped. Wealth evaporated, debt remained, and the crash created its own casualties. The 2008 financial crisis was estimated to cause 500,000 additional cancer deaths globally due to healthcare cutbacks and economic stress. The next crisis, the one being created right now by the current rate cycle, will have its own body count. Now let's talk about the current cycle. March 2022, the Federal Reserve begins raising rates. The official reason is inflation. The inflation rate hit 9.1% in June 2022, the highest in 40 years. The Fed decided it had to act, so they raised rates fast. 4.5 percentage points in 16 months, the fastest increase since Volcker. But here's what the Fed didn't say. They caused the inflation through COVID era money printing. The Fed's balance sheet expanded by 4.7 trillion between March 2020 and April 2022. That's 4.7 trillion in new money created out of nothing, injected into the economy. That money chased limited goods during supply chain disruptions. Prices rose, inflation hit 9%. And the Fed's solution to the inflation they caused: raise interest rates, make borrowing expensive, crash the economy, and kill the people whose businesses and jobs can't survive high rates. The casualties are accumulating now. We're in the middle of the cycle. The full body count won't be known for years. But the early indicators are alarming. Business bankruptcies increased 40% from 2 to 23. Each bankruptcy represents jobs lost, savings destroyed, lives ruined. Foreclosure filings increased 23% in the same period. Each foreclosure represents housing lost, families displaced, stability destroyed. Suicide rates won't be fully reported for another 2 years due to data lag. But crisis hotline calls increased 35% from 22 to 23. The deaths are happening. We just haven't counted them yet, and the Fed knows. They have researchers studying the relationship between monetary policy and social outcomes. Internal papers discuss the unemployment mortality relationship. They understand that raising rates causes deaths, and they do it anyway because their mandate is price stability, not human welfare, not minimizing casualties, price stability. And if thousands of people have to die to achieve 2% inflation, that's acceptable. That's the cost of doing business. Let me show you another dimension of the kill mechanism, the international dimension. Because Federal Reserve policy doesn't just affect Americans, it affects the entire world. The dollar is the global reserve currency. When the Fed raises rates, the dollar strengthens. And a strong dollar crushes developing countries. Here's how it works. Developing countries borrow in dollars because their own currencies aren't stable enough. They borrow dollars to build infrastructure, fund governments, finance development. When interest rates are low, this works. The debt service is manageable. But when the Fed raises rates, the dollar strengthens against other currencies. Suddenly, the debt is more expensive to service. A country that borrowed $1 billion when their currency was 10 to the dollar now owes $1 billion when their currency is 15 to the dollar. The debt increased by 50% in local currency terms without borrowing another dollar. This creates debt crises. Countries can't service their dollar denominated debt. They default or they implement austerity, cut government spending, cut health care, cut food subsidies, cut social services, and people die. Not Americans. Poor people in developing countries. But there's still deaths caused by Federal Reserve policy. The Fed raises rates, the dollar strengthens. Developing countries face debt crises. People die from lack of health care, lack of food, lack of basic services. The chain of causation is direct. The body count is massive. And nobody in America cares because the dead aren't Americans. Let me give you specific examples. Sri Lanka, May 22. The country defaults on its external debt. Inflation hits 50%. Food shortages, medicine shortages, protests turn violent, the government collapses, and people die from malnutrition, from inability to access medical care, from violence during the unrest. How many? Nobody knows exactly. But excess mortality during 2022 is estimated at 15,000 to 20,000 deaths caused by the economic collapse, caused by the debt default, caused in part by Federal Reserve rate increases that made Sri Lanka's dollar debt unsustainable. Pakistan, June 2022, facing similar pressures, dollar debt becoming unsustainable, forced to seek IMF bailout with harsh conditions. Austerity measures cut subsidies for food and fuel. Prices spike. Poverty increases. Healthcare access declines. Malnutrition increases and excess mortality rises. Estimates suggest 10,000 additional deaths during 2022-2023 from economic stress and reduced access to necessities. Egypt, Lebanon, Tunisia, Argentina, Turkey, all facing dollar debt stress, all implementing austerity, all seeing increased mortality. The total body count from Federal Reserve induced developing country debt crises during 2002 to 2024 is likely in the hundreds of thousands, maybe millions if you count reduced life expectancy from permanent economic damage. And the Fed knows this too. They have international economists. They understand capital flows. They know that raising rates causes dollar strength. They know dollar strength causes developing country crises. They know those crises kill people, and they do it anyway because their mandate is domestic price stability, not global welfare. The deaths in Sri Lanka and Pakistan and Egypt don't factor into Fed decision making. Those deaths are externalities, costs borne by others, not Americans, not voters, not their problem. Now let's talk about the pension crisis because this is a kill mechanism that's currently activating, and it's going to cause massive casualties among the elderly over the next decade. Pension funds are designed on assumptions. They assume a certain return on investment, usually around 7% per year. At 7% returns, the contributions from workers and employers are sufficient to fund promised benefits to retirees. But when interest rates were at zero for a decade, pension funds couldn't earn 7% on safe investments. They had to take more risk, invest in stocks, real estate, private equity, and when those markets crashed, the pension funds lost money. Now they're underfunded. They don't have enough assets to pay promised benefits. State pension funds are currently funded at an average of 72%. That means they have 72 cents for every dollar they've promised to retirees retirees. Corporate pensions are worse, around 80% funded on average. Multi-employer pensions serving union workers are catastrophic. Some are below 50% funded. They're going to fail. They're going to cut benefits. And retirees who worked 40 years expecting a certain pension will get a fraction of what they were promised. And pension cuts kill. Retirees don't have time to go back to work and rebuild savings. They can't cut living expenses below survival level. When their pension gets cut by 30 or 40%, they face brutal choices. Pay for medicine or food, heat the home, or see the doctor. Every choice carries health consequences, and those health consequences lead to earlier death. Studies of pension cut impacts are limited because large-scale pension cuts are relatively rare in developed countries. But we have some data. When Detroit cut city pensions during its 2013 bankruptcy, retiree mortality increased. Excess deaths in the years following the cuts suggest a few hundred additional deaths among the relatively small population of Detroit retirees. Now, scale that to the national pension crisis. Millions of retirees facing benefit cuts. Even a small increase in mortality rate produces thousands of deaths. And this crisis was caused by Federal Reserve policy. The decade of zero interest rates made it impossible for pension funds to earn safe returns. They took risk. Some of that risk paid off, much of it didn't. And now the funds are underfunded. When they cut benefits, people will die. Not immediately, over years, but predictably. The Fed's zero rate policy planted the seeds. The current high rate policy ensures the funds can't earn their way out of the hole through high returns on bonds. The pensions will fail, benefits will be cut, and retirees will die earlier than they would have with adequate income. The body count hasn't been calculated yet, but it's coming. Let's talk about the psychological mechanism, because interest rates don't just kill through economic channels. They kill through psychological stress, and stress is deadly. Financial stress is among the most harmful forms of stress humans experience. It's chronic. It's inescapable. It affects every aspect of life, and it has measurable physiological effects. Elevated cortisol, increased blood pressure, chronic inflammation, disrupted sleep, weakened immune system, all of these increase mortality risk. When interest rates rise, financial stress increases, your mortgage payment increases, your debt service increases, your business costs increase, and your revenue doesn't keep pace. You're falling behind, and you know it. That knowledge generates constant stress. You wake up thinking about it, you go to bed thinking about it, you can't escape it. And that chronic stress destroys your health. The research is clear. Financial stress increases risk of heart attack by 50%, increases risk of stroke by 30%, increases risk of diabetes by 40%, increases risk of depression and anxiety disorders massively. And all of these conditions increase mortality risk. Financial stress kills. Interest rate increases cause financial stress. Therefore, interest rate increases kill. The chain of causation is direct. And the Fed knows this. They have behavioral economists. They study how policy affects psychology. They know their decisions cause stress, and they know stress causes health problems and death. But it doesn't factor into their decisions because their models don't include human suffering as a variable. Their models include inflation, unemployment, GDP, not stress, not health, not mortality. Those are externalities, not measured, not optimized, not considered. Now, let me show you something that will make you angry. The Federal Reserve has tools to prevent these deaths. They could raise rates gradually over years instead of months, giving people time to adjust, giving businesses time to restructure, minimizing the shock, but they don't. They raise rates aggressively. causing maximum disruption, maximum business failures, maximum unemployment, maximum stress, because gradual doesn't break inflation fast enough. So they choose the aggressive path, knowing it will kill more people, choosing to kill more people for faster results. They could also provide targeted relief, protect adjustable rate mortgage holders from sudden payment increases, cap the rate increases on existing business debt, create unemployment benefits that actually allow people to survive, but they don't, because that would prevent the economic slowdown they're trying to cause. They want businesses to fail. They want people to lose jobs. They want economic pain, because economic pain is how monetary policy works. The pain is the mechanism. The deaths are acceptable collateral damage. And here's the darkest part: the people making these decisions are insulated from the consequences. Jerome Powell has a net worth over $50 million. The other Fed governors are all multimillionaires. They're not facing adjustable rate mortgage payment increases. They're not losing their small businesses. They're not becoming unemployed. They're protected, wealthy, secure, and they're making decisions that kill people like James Chin, people who did everything right, worked hard, built businesses, made reasonable financial decisions, and got crushed by policy decisions made by people who will never experience the consequences. This is class warfare. The wealthy making policy decisions that kill the working class and middle class. Not intentionally, not maliciously, but inevitably. The Fed's policies protect large financial institutions and wealthy asset holders, and they destroy small businesses and working people. The distribution of pain is not random, it's systematic. The poor and middle class die, the wealthy get richer. This is how monetary policy functions. This is who it serves. And this is why nobody in power discusses the body count. Let me give you more numbers. Because the abstract discussion of death mechanisms needs concrete numbers to be real, to be visceral, to be understood as the mass casualty event it is. The Volcker rate increases of 1980-1982 caused approximately 18,000 excess suicides over 3 years. Add deaths from cardiovascular disease attributable to economic stress, and the number exceeds 40,000. Add deaths from substance abuse, and it approaches 50,000. Add deaths from violence and accidents correlated with economic hardship and unemployment, and you're over 60,000. That's the body count from 2 years of aggressive rate increases. 40 years ago. The current rate cycle is larger and faster than Volcker's. We went from 4.25% to 5.5% in 16 months. Volcker took 3 years to reach his peak. We did it in less than half the time. The shock was greater. The disruption was more severe. Which means the body count will be higher. Estimate conservatively. Assume the current cycle causes half the mortality rate of Volcker's cycle per year because medicine is better and safety nets are stronger. That's still 10,000 excess deaths per year. Over a 5-year period, 50,000 deaths directly attributable to Federal Reserve interest rate policy. That's a September 11th worth of deaths every 2 months caused by policy, caused deliberately, and nobody's calling it what it is. But that's just domestic deaths. Add the international deaths from developing country debt crises: Sri Lanka, Pakistan, Egypt, Lebanon, Tunisia, and dozens of other countries facing dollar debt stress. Conservative estimate of 200,000 excess deaths globally from Fed-induced debt crises during 2022, 2024. Now you're at 250,000 total deaths, 250,000 people dead because the Federal Reserve decided to fight inflation aggressively. And these are conservative estimates. The real body count is likely higher, much higher, because these estimates only include measurable proximate deaths. They don't include deaths from deferred medical care due to financial stress, don't include deaths from worsening chronic conditions due to inability to afford medication, don't include deaths from mental health crises that don't result in immediate suicide but lead to overdose or self-harm later. Don't include deaths from stress-related illness that manifest years later. The full accounting would likely exceed 500,000 deaths globally from a single rate cycle caused by the decisions of 12 people, the Federal Reserve Board of Governors. Now let's talk about the specific victims, the people in the crosshairs, the demographics that central bank policy targets and kills. First, small business owners, people like James Chen. They're leveraged. They have debt. When rates rise, their debt service increases. Their margins compress. They face an impossible choice: default and lose everything, or keep struggling and lose everything more slowly. Many choose the struggle, work longer hours, cut their own pay, stop taking salaries, drain personal savings trying to keep the business alive. The stress is crushing, and for some, it becomes unbearable. The suicide rate among small business owners during economic downturns is significantly higher than the general population. These are people who worked for decades to build something, who employed people, who served communities, and who got destroyed by interest rate decisions they had no control over and couldn't have predicted. Second, adjustable rate mortgage holders, people who bought homes at low rates with ARMs. They did the math, they could afford the payments, but they didn't predict that rates would triple in 18 months. Now their mortgage payment doubled. They can't refinance because home values dropped and they're underwater. They can't sell without taking massive losses. They're trapped. Some will default and lose their homes. Some will drain retirement accounts to keep paying. Some will work two jobs and destroy their health. And some will break under the pressure. The stress of potential foreclosure is among the most severe financial stresses. It keeps people awake at night, ruins relationships, causes health problems, and kills. Third, retirees on fixed income, people who saved their entire lives, who did everything right, who built nest eggs and expected to live on the investment returns, but zero interest rates for a decade destroyed safe returns. They were forced into riskier investments, stocks, real estate, and when those markets crashed as rates rose, their savings declined by 30 or 40%. Now they don't have enough to live on. They can't go back to work in their 70s. They can't rebuild. They face declining living standards, choosing between medicine and food, heat and healthcare. That financial stress in old age kills. It causes stress-related illness. It causes people to defer medical care. It causes people to stop taking necessary medications, and it shortens lives by years. Fourth, the unemployed. When the Fed raises rates to slow the economy, unemployment is the mechanism. Businesses cut jobs, hiring freezes, layoffs increase, and the people who lose jobs face immediate financial crisis. Unemployment benefits replace only a fraction of income. Savings deplete quickly. Bills pile up. Healthcare access disappears when employer-sponsored insurance ends, and the psychological trauma of unemployment is severe. Loss of identity, loss of purpose, loss of structure, loss of dignity. All of that generates depression, anxiety, substance abuse, and eventual health collapse. The longer unemployment lasts, the worse the outcomes, and the Fed's policy intentionally creates that unemployment. Fifth, the global poor. People in developing countries who never benefited from cheap dollar borrowing, but who bear the cost when dollar debt becomes unsustainable, when their governments face debt crises, when food subsidies get cut, when healthcare budgets get slashed, when medicine becomes unavailable, when malnutrition increases. These are the most invisible victims. They're not Americans. They don't vote in American elections. They don't matter to American policymakers, but they're human. They suffer, they die. And their deaths are caused by Federal Reserve policy just as surely as James Chen's death was. These aren't abstract categories, these are real people. Millions of them, each with a story, each with a family, each with dreams that got destroyed by interest rate decisions I made in boardrooms in Washington, D.C., by people who will never meet them, never know their names, never attend their funerals, and never be held accountable for their deaths. Now let's talk about the alternative, because some people will argue that the Fed has no choice, that inflation is worse, that if they didn't raise rates, inflation would spiral and even more people would die from hyperinflation and economic collapse. This argument has some merit. Uncontrolled inflation does cause deaths, but it's not the only alternative. The Fed could have raised rates gradually, um, a quarter point every 6 months instead of three quarters every 6 weeks. Give people time to adjust, give businesses time to adapt. Yes, inflation would take longer to come down, but the human cost would be much lower. The shock would be manageable instead of devastating. Fewer businesses would fail. Fewer people would lose jobs. Fewer deaths. The Fed could have used alternative tools. They could have worked with fiscal policy to reduce demand through targeted taxation instead of broad monetary policy. They could have addressed supply side inflation causes instead of just crushing demand. They could have collaborated internationally to coordinate policy instead of unilaterally strengthening the dollar and crushing developing countries. But they chose the path of maximum aggression because it's faster, because it's within their control, because it's what they've always done, and because the people making the decisions don't bear the costs. They're insulated, they're wealthy, they're protected, and the people who die from their decisions are far away, invisible, uncounted, forgotten. The body count isn't an accident. It's not an unfortunate side effect that couldn't be avoided. It's a choice. The Fed chose aggressive rate increases over gradual ones, chose broad policy over targeted approaches, chose speed over humanity, and chose to accept thousands of deaths as the price of faster inflation reduction. That's not technocratic policy. That's murder by spreadsheet. Killing people through optimization algorithms that assign zero value to human life. Let me show you the projection for the next 5 years, because we're not done. The rate increases might be over for now, but the consequences are still unfolding. Business failures continue. Unemployment continues rising, foreclosures continue accelerating, pension cuts are coming, developing country debt crises are worsening, the body count is going to increase. 224 will see the peak in business bankruptcies. Businesses that held on through 23, hoping for relief, will realize no relief is coming. Rates might come down slightly, but not to the levels that made their debt sustainable. They'll close. Estimates suggest 50,000 additional business failures in 2024 beyond baseline. That's hundreds of thousands of jobs lost, billions in owner equity destroyed, and the associated deaths from owner suicides, worker unemployment, and economic stress. 2025 will see the peak in foreclosures. Adjustable rate mortgages that reset in 24 will reach the point where homeowners can't pay and can't hold on any longer. Foreclosure filings will peak at levels not seen since 2010. Hundreds of thousands of families will lose their homes. The associated deaths from housing instability, homelessness, and the stress of foreclosure will accumulate. 2026 will see the first major pension cuts. Underfunded state and municipal pensions will hit critical thresholds. Courts will approve benefit reductions. Retirees will see their income cut by 20 to 30%. The financial stress and resulting health impacts will show up in increased mortality rates among retirees. 2027 will see developing country debt restructurings. Countries that held on through 2024-2026 will be forced to negotiate with creditors. Austerity programs will be imposed, healthcare and food subsidies will be cut, and mortality rates in those countries will spike. 2028 will see the long-term health impacts emerge. People who experience severe financial stress during 2022-2026 will start showing up with stress-related illnesses, heart disease, stroke, diabetes. Cancer rates may be elevated due to deferred screening and treatment. These deaths will be attributed to medical causes. But the root cause was financial stress, was interest rate policy, was Federal Reserve decisions. The total body count from the 2022-2023 rate cycle won't be fully known until 2030 or later. But based on historical patterns and current trajectories, a conservative estimate is 100,000 excess deaths in the United States and 500,000 globally over the decade following the rate increases. That's 600,000 people dead because the Federal Reserve decided to fight 9% inflation with the fastest rate increases in 40 years. And Jerome Powell will retire with his reputation intact. He'll be praised for taming inflation, for restoring price stability, for doing the hard thing. The 600,000 dead won't be mentioned, won't be counted, won't be attributed to his decisions. He'll write a memoir, give speeches, be celebrated as a consequential Fed chairman, and the bodies will be forgotten. This is the reality of central bank policy. It kills people, not metaphorically, not abstractly, literally. Thousands of them, tens of thousands, hundreds of thousands, with malice aforethought, because they know their policies cause deaths. They have the research, they have the models, they understand the mechanisms, and they choose to execute the policies anyway. Why? Why do they do it if they know people will die? Because their mandate is price stability, not human welfare. The Federal Reserve Act tasks them with maximum employment and stable prices. It doesn't task them with minimizing deaths, doesn't require them to consider mortality, doesn't hold them accountable for the human cost of their policies. So they optimize for their mandate. And human lives are externalities, costs borne by others, not their problem. And who holds them accountable? Nobody. The Fed is independent, insulated from political pressure. The Board of Governors are appointed for 14-year terms. They can't be recalled, can't be voted out. Answer to no one except in theory to Congress, which doesn't actually exercise meaningful oversight. They're an unelected, unaccountable technocracy with the power to engineer recessions, cause unemployment, destroy businesses, and kill people. And they face no consequences. This is the darkest reality of modern monetary policy. A small group of unelected officials with the power to kill thousands through policy decisions, who know they're killing thousands, who choose to kill thousands because it's the most efficient path to their goals, and who face no accountability, no consequences, and no moral reckoning for the deaths they cause. You want to know why James Chen is dead? Because Jerome Powell decided that inflation at 9% was unacceptable, that it needed to be brought down quickly, that aggressive rate increases were necessary, that the businesses and jobs destroyed were acceptable costs. James Chen's restaurant was one of those acceptable costs. His life
was an acceptable cost, and nobody in power cares. You want to know why thousands of retirees will die earlier than they should? Because the Fed kept rates at zero for a decade.
Destroying safe returns, forcing pension funds into risky assets that later crashed. Because the Fed prioritized bank profits and stock market gains over pension fund solvency, because retiree welfare wasn't a consideration, and now those retirees will pay with their lives. You want to know why hundreds of thousands of people in developing countries will die from debt crisis austerity? Because the Fed raised rates without considering international impacts, because dollar strength crushes dollar debtors, because American monetary policy has global consequences, and those consequences include death, lots of death, but not American death. So it doesn't matter. This is central banking in the 21st century. Technocratic, optimized, ruthless, and deadly. The body count is hidden, the mechanisms are complex, the deaths are diffuse and delayed. So nobody sees it as the mass casualty event it is, but it is. Hundreds of thousands dead from policy decisions, democide by spreadsheet, murder by interest rate. The Fed will tell you it's necessary, that fighting inflation requires hard choices, that unemployment has to rise, that businesses have to fail, that economic pain is the price of price stability. And maybe that's true. Maybe fighting inflation does require economic pain, but that doesn't absolve them of responsibility for the deaths their policies cause, doesn't excuse the lack of consideration for human cost, doesn't justify the refusal to explore alternatives that might cause less harm. They have blood on their hands, they know it, and they don't care. Because in their worldview, they're technocrats, making optimal decisions based on models and data. The dead aren't in the models, aren't in the data, aren't part of the optimization function. So the dead don't matter. This is the hidden body count of central bank policy when interest rates kill, not metaphorically, literally, with real bodies, real deaths, real families destroyed, and nobody counting, nobody accounting, nobody holding the killers responsible. James Chin is dead. His restaurant is gone. His employees lost their jobs. His equity is gone. His family is devastated. And the Federal Reserve Board of Governors sleeps soundly because they don't know James Chin didn't intend to kill James Chin, just created the conditions that made James Chin's death inevitable. And in their calculus, that's not their fault. That's not their problem. That's just monetary policy working as designed. You've been shown how interest rates kill the mechanisms, the body count, the victims, the perpetrators, and the complete absence of accountability. This isn't a warning about what might happen. This is documentation of what's happening now, what's been happening for decades, what will continue happening as long as central banks have the power to engineer recessions and cause unemployment and destroy businesses in pursuit of price stability. The next time you hear that the Fed is raising rates to fight inflation, remember James Chen. Remember the 100,000 Americans who will die over the next decade from the current rate cycle. Remember the 500,000 people globally who will die from developing country debt crises. Remember that interest rates aren't just numbers on a chart, they're life and death. And the people setting those rates know they're causing death, and they do it anyway. When interest rates kill, the hidden body count, the forgotten victims, the unaccountable perpetrators, and the system that allows it all to continue. Generation after generation, crisis after crisis, body after body, legally, officially, inevitably. The weapon has been shown, the casualties have been counted, and the murderers remain free. Because when you kill with interest rates instead of weapons, when you kill thousands instead of millions, when you kill slowly instead of quickly, society doesn't call it murder. Society calls it monetary policy. And the dead are just externalities, acceptable losses. The cost of fighting inflation, James Chen's empty restaurant, his name on a death certificate, his family's grief, multiplied by thousands, by tens of thousands, by hundreds of thousands. That's the true cost of central bank policy. That's the hidden body count. And it's not hidden anymore. Let me show you another dimension of how central bank policy kills that nobody discusses: the medication crisis. When people lose jobs or businesses due to rate induced recession, they lose health insurance. When they lose health insurance, they can't afford medications. And when they can't afford medications, chronic conditions become fatal. Take diabetes. About 37 million Americans have diabetes. Most require insulin and other medications to manage the condition. With insurance, these medications are affordable. Without insurance, insulin alone costs $300 to $400 per month. Add testing strips, other medications, doctor visits, and the monthly cost exceeds $800. Someone who loses their job and insurance due to Fed-induced recession suddenly faces an impossible choice. Pay $800 per month for diabetes care, or pay rent and food. Many choose rent and food. They ration insulin, skip doses, stop testing blood sugar, stop seeing doctors, and their diabetes spirals out of control. Diabetic ketoacidosis, kidney failure, heart disease, blindness, amputations, and eventually death. Much earlier death than if they'd maintained treatment. Studies show that uninsured diabetics die 5 to 7 years earlier than insured diabetics on average. Every person who loses insurance due to Fed induced unemployment and has diabetes loses years of life, maybe decades. How many people lose insurance during a rate induced recession? Millions. How many of those have chronic conditions requiring ongoing medication? Tens of thousands at minimum. How many die earlier than they would have? Nobody's counting, but the mechanism is direct. Fed raises rates, businesses fail, people lose jobs, people lose insurance, people can't afford medication. People die, the Fed killed them. The same pattern applies to hypertension, asthma, mental health conditions, HIV, cancer treatment, and dozens of other conditions requiring ongoing medication. Every uninsured person with a chronic condition faces premature death, and every Fed-induced recession creates millions of uninsured people. The body count from medication rationing alone could be tens of thousands per recession cycle. And this is entirely preventable. The Fed could raise rates gradually, could coordinate with fiscal policy to maintain healthcare subsidies during recessions, could time rate increases to minimize unemployment, but they don't. Because preventing these deaths would require considering human welfare. And human welfare isn't in their mandate, isn't in their models, isn't their concern. Let me give you specific cases. Real people, real deaths. Names have been changed, but the stories are real. Sarah Martinez, age 43, asthma, lost her job in November 2023 when the manufacturing company she worked for closed due to inability to service debt after rate increases. Lost health insurance, couldn't afford her asthma medications. Albuterol inhaler is $75 without insurance. Controller medication is $250 per month. She couldn't afford it, started having more frequent attacks, ended up in emergency room 3 times in 4 months. The ER stabilized her but wouldn't provide ongoing medication without insurance. In March 2024, she had a severe attack, called 911. Paramedics arrived too late. She died before reaching hospital. Age 43, left 2 children. Cause of death, asthma attack. Actual cause, lost insurance due to Fed-induced business closure.
David Thompson, age 58, hypertension and high cholesterol, owned a small commercial real estate development company. When rates rose, his construction loans became impossible to service. Development projects went underwater. Company bankrupt by August 2003. Lost health insurance, couldn't afford blood pressure and cholesterol medications. Combined cost without insurance, $400 per month. Stopped taking them, figured he was strong, could manage. Had a stroke in January 24. Survived, but with significant disability. Can't work, can't speak clearly, can't live independently. His wife became a full time caregiver. Their retirement savings depleted, paying for care. He might live another 20 years, but those years will be diminished, painful, expensive. His stroke was preventable. If he'd kept taking his medications, the stroke likely doesn't happen. But he couldn't keep taking his medications because the Fed's rate increases destroyed his business and his insurance. Patricia Anderson, age 67, breast cancer survivor. Her pension was from a multi employer union fund. The fund was underfunded due to poor returns during zero rate years and losses when rates rose. In 2024, the fund cut benefits by 35%. Her pension dropped from $2,200 per month to $430. She needed ongoing monitoring for
cancer recurrence, mammograms, blood tests, oncology appointments. With Medicare, her out of pocket costs were about $200 per month. With her reduced pension, she couldn't afford it and also pay rent and eat. She skipped her 6 month mammogram, skipped the 1 year follow up. When she finally went in for a scan in 2026 because she felt a lump, the cancer had returned and metastasized. Stage 4, inoperable. She died in 2027. If she'd maintained her monitoring schedule, the recurrence would have been caught early, would have been treatable. She'd likely have lived another 15 years. Instead, she got 3 years of diminished life and painful death because a pension fund cut benefits, because the pension fund lost money during rate cycles, because the Fed's policy destroyed returns and created losses. The Fed killed Patricia Anderson. These aren't unusual cases, these are patterns repeated millions of times across the country. Each one is a person, each one is a death. Each one is caused, however, indirectly by Federal Reserve policy, and each one is invisible to the people making that policy. Now, let's talk about the suicide mechanism in detail, because suicide is the most direct, most measurable, most undeniable element of the body count. And the data is clear and horrifying. Suicide rates correlate strongly with economic conditions. During recessions, suicide rates increase. During recoveries, they decrease. The relationship is consistent across countries, across decades, across demographics. Economic stress causes suicide, and Federal Reserve policy causes economic stress. Therefore, Federal Reserve policy causes suicide. The mechanism operates through multiple channels: job loss, business failure, foreclosure, debt stress. Each one increases suicide risk, and they compound. A person who loses their business often also loses their home, their savings, their marriage, and their sense of identity. Each loss increases risk. Together, they create an overwhelming burden that some people can't survive. Let's look at the numbers from previous recession cycles to project the current one. During the 2008-2009 recession, U.S. suicide rates increased from 11.3 per 100,000 in 2007 to 12.1 per 100,000 in 2009. That's a 7% increase. Applied to a population of 300 million, that's approximately 2,400 additional suicides. Over the 2 year acute recession period, roughly 5,000 excess suicides directly attributable to the economic crisis. But the 2008 crisis had multiple causes: subprime mortgages, financial system collapse,
It wasn't purely a rate-induced recession. The current cycle is different. It's almost entirely rate-induced. The economy was recovering well from COVID. Unemployment was low. Growth was positive. Then the Fed raised rates aggressively and intentionally slowed the economy. This is a cleaner case of central bank policy causing recession, which means the attribution of deaths to Fed policy is more direct if we assume similar suicide.
Rate increases during the current cycle, and early data suggests the increases may be larger. We're looking at 3,000 to 5,000 excess suicides per year during the acute recession period. Over a 3-year period, 2023 2025, that's 9,000 to 15,000 excess suicides directly caused by economic conditions, directly caused by Fed policy. And that's just the United States. Globally, the pattern repeats. Developing countries facing debt crises show even larger suicide rate increases. Greece, during its debt crisis, saw suicide rates increase by 35%. Spain saw 15% increases. Italy, 12%. If developing countries facing dollar debt stress in 2024 see similar patterns, the global excess suicide count could be 50,000 or more over a 5-year period. Every one of those suicides is a person who couldn't bear the burden anymore, who saw no way out, who felt that death was better than continuing to face the financial stress and failure and loss. And every one of them died because central banks decided that fighting inflation required economic pain, required business failures, required unemployment, required suffering. The Fed doesn't pull the trigger, but they create the conditions that make pulling the trigger seem like the only option. That's not absolution, that's causation, and they need to be held accountable for it. Let me show you another mechanism, the family violence mechanism. Economic stress increases domestic violence. Job loss, business failure, financial stress, all of these increase rates of intimate partner violence and child abuse, and domestic violence kills. The data is clear. During recessions, domestic violence increases, hotline calls increase, police reports increase, emergency room visits for assault increase, and homicides within families increase. Economic stress doesn't excuse violence, but it's a documented precipitating factor. And central bank policy that increases economic stress increases violence. Estimates suggest that recession associated increases in domestic violence result in hundreds of additional deaths per year. Intimate partner homicides, child abuse, fatalities, murder suicides driven by financial desperation. Each one is a tragedy. Each one has multiple victims, the person killed and the family destroyed, and each one is a downstream consequence of monetary policy. Nobody at the Federal Reserve thinks about this. When they vote to raise rates, they're thinking about inflation data, labor market indicators, GDP forecasts. They're not thinking about the man who loses his business and takes out his rage and desperation on his family. They're not thinking about the woman who can't afford to leave an abusive partner because she lost her job and has no income. They're not thinking about the children who suffer increased abuse because their parents are drowning in financial stress, but they should be, because their policies create those conditions, their decisions have those consequences, and ignoring those consequences doesn't make them less responsible. Let's talk about the addiction and overdose mechanism. Economic stress increases substance abuse. Job loss doubles the risk of alcohol abuse disorder. Business failure increases drug use. Financial stress drives people to self-medicate with substances, and substance abuse kills. The opioid crisis in America has killed over 600,000 people in the past 2 decades. The crisis began in the early 2000s with prescription opioids, accelerated in the 2010s with heroin, and exploded in the 2020s with fentanyl. But the underlying driver of the crisis is despair, economic despair, the loss of good jobs, the destruction of communities, the sense that the future holds nothing but decline. This is deaths of despair. And monetary policy contributes to that despair. When the Fed raises rates and causes recession, unemployment increases. Communities that were economically marginal become economically devastated. People who were managing their substance abuse relapse under increased stress. People who never use substances start using to cope, and overdose deaths increase. Data from 2008 2009 shows that overdose deaths increased during that recession. They decreased during the recovery, then increased again during COVID. And the early data from 2023 suggests they're increasing again as the rate induced slowdown takes hold. The correlation between economic conditions and overdose deaths is clear. A worse economy, more overdoses. Better economy, fewer overdoses. If the current rate cycle increases overdose deaths by even 5%, that's 5,000 additional deaths per year. Over 5 years, 25,000 deaths. Added to suicides, to medication rationing deaths, to violence deaths, to stress related illness deaths, the body count grows and grows and grows until you're looking at 100,000 or more um, excess deaths over a decade, all flowing from the decision to raise interest rates aggressively. And still nobody's counting, still nobody's holding the Fed accountable, still nobody's even acknowledging that these deaths are happening and that monetary policy is a contributing cause. Let me show you the institutional mechanism. The nursing home crisis. Many nursing homes operate on thin margins. They finance operations with debt. When interest rates rise, their debt service increases. When Medicare and Medicaid reimbursement rates don't keep pace, they face insolvency. And when nursing homes go bankrupt, residents suffer. During 2023-2004, nursing home bankruptcies increased significantly. Operators couldn't service debt after rate increases. Facilities closed. Residents were displaced. Some died during transfers. Others died from declining care quality at facilities cutting costs to survive. The body count isn't being tallied, but it's happening. Elderly people are particularly vulnerable to disruption. Moving from one facility to another increases mortality risk. Studies show that nursing home residents who are transferred have significantly higher mortality in the 6 months following transfer. When a nursing home closes and residents are forced to relocate, some of them die from the stress and disruption of the move. How many? Nobody knows. But every closure results in deaths that wouldn't have occurred if the facility had remained open and stable. And why did the facilities close? Because interest rates increased, because debt service became unsustainable, because the Fed decided that fighting inflation required raising rates. The chain of causation is direct. Fed raises rates. Nursing homes can't service debt. Facilities close. Residents are displaced. Some residents die from displacement. The Fed killed them. The same pattern occurs with rural hospitals. Small hospitals in rural areas often operate on minimal margins. They finance capital improvements with debt. When rates rise and debt service increases, some can't survive. They close. And when a rural hospital closes, the nearest hospital might be 50 or 100 miles away. People having heart attacks die in transit. Women having complicated deliveries die because they can't reach a hospital in time. Trauma victims die from delayed care. Every rural hospital closure costs lives. And rate-induced hospital bankruptcies cause closures. Between 2010 and 2020, 38 rural hospitals closed. Many of those closures occurred during or after periods of increases. The correlation isn't perfect because multiple factors affect hospital viability, but interest rates are absolutely a factor. And when rural hospitals close due to inability to service debt after rate increases, the Fed bears responsibility for the deaths that result from reduced healthcare access. Now, let's talk about the intergenerational mechanism, the opportunity mechanism, because the Fed's policies don't just kill people now, they kill people's futures. They destroy opportunities for the next generation, and that has mortality implications that extend decades. When the Fed keeps rates too low for too long, asset prices inflate. Housing becomes unaffordable for young people. They can't buy homes, they rent forever. Renting is more expensive than owning, leaving less money for savings, healthcare, food. Financial stress throughout life leads to worse health outcomes. Lower life expectancy. The Fed's zero rate policy that inflated housing prices killed people who haven't died yet. Young people who can't afford homes will have shorter, harder lives than they would have if housing had remained affordable. When the Fed raises rates quickly, they crash markets. Young people who were investing for retirement see their 401ks decline by 30 or 40%. They lose years of progress toward retirement security. They'll work longer, retire later, have less in retirement. And financial insecurity in old age kills through stress, through deferred medical care, through inability to afford medications. The Fed's current rate cycle is shortening the lives of people in their 30s and 40s. They just won't die for another 30 or 40 years. But the mechanism is already in motion. This is theft of life, not from the present, but from the future. And it's invisible because the deaths are delayed, but they're just as real, just as caused by Fed policy, just as preventable if the Fed had managed rates more carefully. Let me show you the psychological trauma mechanism. Beyond depression and suicide, economic trauma causes lasting psychological damage, PTSD from business failure, anxiety disorders from foreclosure, adjustment disorders from job loss. These conditions don't always result in immediate death, but they reduce quality of life, increase health risks, and shorten lifespan. People who experience severe economic trauma show elevated markers of chronic stress for years afterward. Elevated cortisol, chronic inflammation, impaired immune function. Um, all of these increase risk of heart disease, cancer, diabetes, and other conditions that shorten life. The trauma from Fed-induced economic devastation creates health consequences that manifest a decade later as premature death. Nobody connects those deaths to the original cause. When someone dies of a heart attack at 62, the death certificate says heart disease. It doesn't say contributed to by chronic stress from business failure during the 23 rate-induced recession, but that's often the reality. The Fed's policy set in motion a cascade of stress and trauma that culminated in premature death years later. If we tried to fully account for these delayed stress-mediated deaths, the body count from any given rate cycle would double or triple. Instead of 100,000 deaths from the current cycle, you'd be looking at 300,000. Instead of 600,000 globally, you'd be looking at nearly 2 million. The true body count is massive and completely uncounted. Now let's talk about specific demographics and how they're targeted. Because the Fed's policies don't affect everyone equally. They target specific groups, and some of those groups have much higher mortality risk from economic stress. Black Americans face higher mortality risk from economic stress than white Americans. They have less wealth to buffer shocks. Lower rates of insurance coverage, less access to health care, higher rates of chronic conditions. When the Fed causes recession and unemployment rises, black unemployment rises faster and stays elevated longer. And black mortality from economic stress is higher. Studies show that during recessions, black mortality increases more than white mortality. The Fed's policies have racially disparate impacts, and those impacts include higher death rates for black Americans. Rural Americans face higher mortality risk from economic stress than urban Americans. They have less access to health care, fewer hospitals, longer distances to emergency care, higher rates of poverty. When rural hospitals close due to rate-induced financial stress, rural Americans die from lack of access. When rural businesses fail, rural Americans face a longer-term unemployment because there are fewer alternative employers. The Fed's policies devastate rural America disproportionately, and rural America dies disproportionately. Low income Americans face massively higher mortality risk from economic stress. They have no savings to buffer shocks, no assets to sell, no credit to access. When they lose a job, they lose everything immediately. When they can't afford medication, they go without. When they face financial stress, they have no resources to manage it, and they die at much higher rates. The Fed's policies kill poor people at rates far exceeding the deaths among middle class and wealthy people. The Fed knows this. They have economists studying distributional impacts of monetary policy. They know rate increases hit the poor hardest, hit minorities hardest, hit rural Americans hardest, and they do it anyway because their mandate is price stability for the economy overall, not protection of vulnerable populations. The disparate impact is documented, known, and ignored. This is structural violence. Using policy tools that disproportionately harm vulnerable populations, knowing those populations will suffer and die at higher rates, and doing it anyway because the benefits to powerful interests, banks, bondholders, wealthy asset holders, outweigh the costs to powerless populations. That's not technocratic policy. That's class warfare, race warfare, geographic warfare, using interest rates as the weapon. Let me give you the counterfactual. What if the Fed had acted differently? What if they had raised rates gradually over 3 years instead of aggressively over 16 months? What if they had coordinated with fiscal policy to maintain social support during the transition? What if they had considered mortality impacts in their decision making? The inflation would have come down more slowly, taken 3 years instead of 18 months. During that time, prices would have remained elevated. People would have faced continued cost pressures, but businesses would have had time to adapt. Debt service increases would have been manageable. Unemployment would have increased gradually instead of spiking. Financial stress would have been chronic but manageable instead of acute and devastating. The body count would be much lower. Instead of 100,000 excess deaths, over a decade, maybe 30,000. Instead of 600,000 globally, maybe 200,000. Still significant, still tragic, but a third of what we're facing with the actual policy path chosen was that extra 70,000 American lives and 400,000 global lives worth getting inflation down 18 months faster. That's the trade-off. That's what the Fed chose. Speed over lives, aggressive over gradual, and 470,000 people will die because of that choice. But the Fed didn't consider that trade-off, didn't calculate the body count, didn't weigh lives against timeline, just optimize for their mandate using their models. And their models don't include human mortality as a variable. So mortality was never part of the decision. This is the fundamental problem. Central banks operate using models that don't account for human suffering. They optimize for abstract variables. GDP, inflation, unemployment rate. They don't optimize for human welfare, for lives saved, for suffering minimized. And as long as their models ignore mortality, their policies will keep killing people, and nobody will notice. Nobody will care. Nobody will hold them accountable. Let me show you what accountability would look like. Imagine if every FOMC meeting where the Fed votes on interest rates included a mortality impact statement. If we raise rates by 75 basis points, our models project 15,000 additional deaths over the next 3 years through unemployment, business failures, foreclosures, and related mechanisms. If we raise rates by 25 basis points, we project 8,000 additional deaths. If we maintain current rates, we project 5,000 additional deaths from continued inflation impacts. If that information was in front of them every meeting, if they had to vote knowing the specific body count of each option, would they make different decisions? Maybe, maybe not. But at least the decision would be transparent. At least we'd know that they knew that they chose to kill 15,000 people for faster inflation reduction, and then we could hold them accountable. But that doesn't happen. There's no mortality impact statement, no accounting for deaths, no transparency about the human cost, just votes on rate changes based on inflation data and labor market indicators, and the bodies pile up invisibly. Let's talk about the savings and loan crisis of the 1980s and early 1990s. Another Fed induced casualty event. Volcker's rate increases to fight inflation didn't just cause unemployment and business failures. They destroyed the savings and loan industry. S&Ls held long-term fixed rate mortgages. When rates rose to 20%, those mortgages were worth far less than face value. The S&Ls were insolvent. Over 1,000 S&Ls failed. The Resolution Trust Corporation was created to clean up the mess, cost taxpayers $100 billion. But the human cost was enormous. S&L employees lost jobs. Depositors at failed institutions faced uncertainty about their savings. Small businesses that relied on S&L financing lost access to credit. Communities served by those institutions lost local lending capacity, and people died from unemployment, from business failures, from stress. The S&L crisis was a Fed-induced crisis, and it killed people. Nobody counted the bodies, but they existed. The same pattern appears in every Fed-induced crisis. The 1991 recession. Fed raised rates in 1988-89 to fight inflation, caused recession. Unemployment rose, businesses failed, people died. The 2000-2001 recession. Fed had raised rates in 1999-2000. Dot-com bubble burst. Recession followed, unemployment rose, people died. The pattern is consistent. Fed raises rates, economy slows, people die. Then the Fed lowers rates, economy recovers, and the dead are forgotten. This cycle has repeated every 8-12 years for the past 50 years. Each cycle kills thousands. Maybe tens of thousands. Accumulated over 50 years, the Fed has killed hundreds of thousands of Americans through interest rate policy, and millions globally when you include developing country impacts. This is not an institution that should be insulated from accountability. This is an institution that wields life and death power over millions, and it does so with no democratic oversight, no transparency about human costs, and no consequences for the deaths it causes. Let me show you one more mechanism, the research funding mechanism. When the Fed causes recession, government revenues decline. When government revenues decline, research funding gets cut. Medical research, public health research, disease prevention research, and cuts to research funding cause deaths years later, decades later, but inevitably. Every dollar not spent on cancer research is a cancer that doesn't get cured. Every dollar not spent on heart disease research is a treatment that doesn't get developed. Every dollar not spent on public health is a disease outbreak that doesn't get prevented. And Fed-induced recessions reduce those research dollars. The deaths from that reduced research are delayed. The cure that would have been discovered in 2030 doesn't get discovered until 2035. The people who would have been saved die. But nobody connects their deaths to the 2023 recession that cut the research funding that delayed the cure development. This is another invisible component of the body count, probably the largest component, because research funding impacts accumulate over time and affect millions of people. The full accounting of Fed-induced mortality would have to include these delayed research-mediated deaths. And if you did that accounting, the body count from any given rate cycle could be in the millions globally over decades. The cascade effects of economic disruption ripple forward in time and compound. We'll never know the full count. It's impossible to measure, impossible to attribute, impossible to prove. But the mechanism is real, the deaths are real, and the Fed bears responsibility for setting the mechanism in motion. Now, let me show you the comparison to actual violence to put the body count in perspective. The September 11th attacks killed 2,977 people. That was a national tragedy. We went to war, we reorganized government, we spent trillions on security, we memorialized the victims, we swore never to forget. The Fed's current rate cycle will kill 100,000 Americans over a decade. That's 33 September 11ths. But there will be no war, no government reorganization, no memorials, no never forget, because the deaths are diffuse, spread over years and millions of people, one death here, two deaths there. They don't register as a mass casualty event, even though the cumulative toll far exceeds any terrorist attack. The Iraq War killed about 4,500 American service members. That was considered a significant cost, a price that became politically unsustainable. The Fed's current cycle will kill 100,000 Americans, 2 times as many as the Iraq War. But there's no protest, no political pressure, no calls to change policy, because the deaths aren't labeled as war casualties. They're labeled as suicides, heart attacks, overdoses, untreated diabetes. The cause is hidden, the responsibility is diffuse, and nobody's held accountable. COVID-19 killed about 1.1 million Americans. That was a pandemic, a national emergency. We shut down the economy, spent trillions on relief, developed vaccines at unprecedented speed. The Fed's rate cycles over the past 50 years have killed a comparable number, but spread over decades. And there's no emergency, no relief, no vaccine, because nobody sees it as a single event. Nobody connects the deaths to the cause. This is how institutional violence works. It kills more people than dramatic violence, but it does so quietly, slowly, through mechanisms that appear normal, appear like policy, appear like inevitable consequences, rather than deliberate choices. And because it appears normal, nobody stops it. Nobody protests it. Nobody even acknowledges it's happening. The Fed is more deadly than any terrorist organization, more deadly than most wars, more deadly than many pandemics. But because they kill through interest rates instead of bullets, because they kill through economic mechanisms instead of direct violence, their body count is invisible, uncounted, unacknowledged, and unpunished. This needs to change,
not through violence against Fed officials, not through destruction of the institution, but through transparency, through accountability, through forcing the Fed to calculate and publish the mortality impacts of their decisions, through requiring them to minimize deaths as part of their mandate, through making human welfare an optimization variable instead of an externality. If the Fed was required to minimize deaths while achieving price stability, they would choose different policies: gradual rate increases instead of aggressive ones, coordination with fiscal policy to protect vulnerable populations, consideration of mortality impacts in decision making. The inflation might come down slower, but fewer people would die, and that should be the priority. Price stability isn't more important than human life. 2% inflation isn't worth 100,000 deaths. Getting there in 18 months instead of 36 months isn't worth 70,000 extra deaths. These should be obvious statements. But in the current framework, they're not even considered because the Fed's mandate and models don't include human welfare. That's the fundamental reform needed. Change the mandate, change the models, make human welfare central, make mortality a variable, make the Fed accountable for the deaths they cause, not through criminal
prosecution, but through transparency and public accountability. Let the public see the trade offs. Let the public decide if faster inflation reduction is worth thousands of deaths. Let democracy function instead of letting unelected technocrats make life and death decisions in secret. Until that happens, the Fed will keep killing people, cycle after cycle, recession after recession, body after body, and nobody will stop them because nobody sees it, nobody counts it, nobody acknowledges it. James Chen is dead, Sarah Martinez is dead, David Thompson is permanently disabled, Patricia Anderson died of preventable cancer recurrence, and 100,000 more Americans will die over the next decade from the current rate cycle. Each one is a person. Each one had a family. Each one had dreams and plans and people who loved them. And each one died because 12 people in Washington, D.C. decided that fighting inflation aggressively was more important than minimizing deaths. This is the hidden body count of central bank policy. When interest rates kill, not metaphorically, not abstractly, literally, with real deaths. Real funerals, real graves, and real responsibility that nobody wants to acknowledge. You've been shown the mechanisms, the victims, the body count, the perpetrators, and the absolute absence of accountability. This is how institutional violence works in the 21st century, not through soldiers and weapons, through policy and interest rates. And it kills just as effectively, just as deliberately, and just as preventably. The next time the Fed raises rates, remember this. Remember that they're not just changing a number, they're ending lives, thousands of them. And they know it, and they do it anyway. When interest rates kill, the hidden body count, the forgotten victims, the unaccountable perpetrators. This is the reality of modern central banking. This is the price of price stability. And this is the truth nobody wants to face.